Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup-Larsen.
Welcome back to this week's edition of the Systematic Investor Series with Rob Carver and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. Rob, it is wonderful to have you back on this autumn Thursday. Hope you're doing well. How are things in the UK?
The sun is shining. It's quite warm, quite pleasant. It's a very nice autumn day here, and it does seem it seems like a long time since we've spoken, although it's probably not been that long. I'm looking forward to getting through some questions and interesting topics today.
Yeah, pretty full agenda, I have to say. Before we get into all of that, and there are quite a few questions, and we've got a couple of really important topics, as usual, it's always good to start with just sort of what's been on our minds recently, what's been our radar, what are the kind of things that caught our attention. So I'm going to let you go first with something that you found interested.
Yeah. So I don't know if you remember. I've got a couple of pet hates actually. So one of my pet hates is people blaming CTAs for everything. So I was very disappointed to see an article on the Financial Times website this week, which was blaming CTAs for the volatility in oil prices. So I actually wrote something for the FT a while ago now, sort of do some maths and explaining like why, I think it was Goldman's had blamed CTAs for basically moving the equity markets, and immediately some simple maths saying, look, we're just not big enough. I mean, we'd love it, wouldn't we, if CTAs had sort of $5 trillion under management and could genuinely be responsible for moving the markets in such a big way, but sadly that's not the case. And we're actually quite small players, and even with a bit of leverage, which obviously we use, we're not really big enough to move things in markets. There might be a few pockets of markets out there where they're not especially liquid and where there's not much kind of real commercial activity going on, and there's a lot of sort of speculative activity. But most CTAs are quite sensible and don't sort of try and trade in size that means they would move markets. So I was disappointed, but not really surprised to see yet another kind of oil price volatility is down, all down to CTAs. I think it's very unlikely.
So was it just a sort of a general comment in the article that we as CTAs are behind, or were there anything in terms of they were pushing the price in a certain direction? Because I was looking at it when you send over the link, and first of all, if they're talking about recently, I mean, oil prices, they're up only about 1% in the last month, right? Now, since April, it's been selling off. I think we hit a high of $87 down to $65. We're at 72 right now. And actually, I suspect that oil hasn't been a very good market for CTAs this year. I mean, a lot of models would have tried to go long early on, been disappointed by trying that. And now we're probably kind of flat, slightly short. But not even all oil contracts is what I'm trying to say, is the same this year. It's kind of diverse. So
it does make me laugh because I'm with sort of giving a hint to people that later on in this episode we're going to speak about one of my other bugbears, which is replication of CTAs. If you do any kind of basic replication of position sizing and behavior, and you've got an understanding of how things like momentum and volatility drive our positioning. You do that and you say, well, actually, it's quite unlikely that we've got very big positions on at all. One of the things I sometimes do is run down my positions. I've not done that. I don't plan to do that today, but I can very quickly tell you that if I do look at my positioning as of now, where am I? Do I have even a position in crude? I do have a position in crude. but it's very small. And, I've got a small short on. And that's what you'd expect, I think, probably given the price activity. It's not like we're at you can sort of plausibly say if there'd been a really long, smooth trend, which you'd expect CTAs to buy into with big positions because the trend is smooth, therefore volatility is low, therefore leverage would be high. And that, in a position where that trend's sharply reversed, you potentially expect a lot of CTAs to rush the door and sort of increase the size of any move downwards. But that's clearly not what's happened in oil. So yeah, there we go. We're the bogeyman behind every door. But you open the door and there's just a small child dressed in a bedsheet. There you go. There's a Halloween analogy for you.
Absolutely. And before we jump to another article that you just mentioned before we hit record, I just want to mention one thing to people, because I do think it's such an informative example, and that's this year in cocoa, where a lot of people thought, well, the price has gone up by X 100%. Clearly, that must be CTAs pushing the price higher. Well, in fact, we've sold about 90% of our cocoa into that rally. Because, as you mentioned, when vol expands, we contract our position size. So sometimes these moves are actually completely opposite of what we are being, blamed for. Anyways, you mentioned another article that I'm not familiar with. So do tell.
This is even more disappointing. So, this is my day to be disappointed, I'm afraid. So this came out in risk.net, which is the online version of Risk Magazine. And Risk Magazine is a very kind of prestigious magazine and famous for publishing articles full of lots of equations. So it's very much the kind of higher and more intellectual end of the financial publishing industry. The article's called "Should Trend Followers Lower Their Horizons?" And it's quite, it's got has got equations in it. So spoiler alert there. But it has got a graph showing that in August, when a lot of CTAs didn't do very well, short-term CTAs did do well. Okay, well, that happens from time to time. You'd expect that, right? I mean, they're very different sort of styles of trading in many ways. Just because you're following trends, you would expect the correlation between short-term trend followers and long-term trend followers to be probably not zero or negative, but it's not going to be especially high, because they're looking for very different dynamics in the market that they're picking up on. And there'll clearly be times when short-term trend followers will do well, which is when trends are kind of happening, but at short time periods, while at a period of time when long-term trend followers will be whipsawed and will lose money. And you can imagine a converse situation where a short-term trend follower will be whipsawed because the market's kind of moving up slowly, but in a series of sort of jagged spikes. And each of those spikes is kind of whipsawing the short-term trend followers. So yeah, it's fair enough that sometimes short-term will do well, sometimes long-term will do well. But what's disappointing is the fact that this article kind of seems to imply to a degree that, this 1 month of performance, it's not even like, over the last few years, you've noticed short-term doing well, long-term trend following. It's 1 month of performance. So another of my bugbears is people, not using enough data to make decisions with. So, when we're doing our back testing of our own strategies, we want to get as much data as possible because, we want to get lots of economic cycles and make sure that we're not picking up on something that's just a temporary event. If I had somebody working for me and who came up with a back test that was 1 month long, they'd be out the door. The only place that might make sense is in the high frequency space where you can get enough data points for the month data to get a statistically significant result. So I was quite disappointed by Risk Magazine, publishing this article, because really those guys should know better. I mean, at the end, it does say, this is just 1 month. Is it a blip? But that's after a whole article full of implication that, oh my goodness, August was terrible. Therefore, we should be trading shorter. So there we go. That's two publications that I respect greatly, the Financial Times and Risk Magazine, doing quite a poor job, I'm afraid, with portraying our industry this week.
So clearly we're not going to get any love from those magazines anytime soon. But
no free subscription.
Now that you talk about the topic, I did actually notice that as well. I didn't realize it was from Risk Magazine. And I also thought exactly what you explained. I thought that's a very odd article to come out with, especially because some of the names they mention as having done well for 1 month, we know that they've been struggling for a long time. So it's completely nonsense. But that's what you get sometimes in mainstream media.
I'm going to make one more point on that
Yes.
article, if I may now. As I've just noticed, they've got a graph which shows, it's worth looking at the article, it's not a terrible article. One thing that's quite interesting in it is they've got a graph of CTA dispersion by style, showing different categories of CTA and how they did in August. Now, as I said, don't draw any conclusions from that graph because 1 month is irrelevant. What is quite interesting is if you look at the categories of CTA that they've got there. So they've got trend following, which I guess is kind of us, probably, and probably represents the majority of the CTA industry still. They've got short term. Then they've got option writers and option strategy, and multi-strategy, and market neutral and fundamental. A lot of these things don't sound very CTA to me, but then, CTA is one of these nebulous concepts, and we can have a long debate. And I think I've touched on it before. What does it actually mean? But of course, the new category in there, you won't be surprised to see, is AI. So the AI CTAs are now being tracked on this dashboard, and no doubt we will see lots of people jumping on that particular bandwagon. And that's another of my bugbears. But anyway, enough.
Yeah, we need to save something for next time you're back. But no, interesting, and I appreciate that. So what hit my radar has nothing really to do with CTAs as such, but this is also the segment where we can go a little bit off the beaten path, so to speak. I was thinking actually of the sell-off in bonds, which does relate to CTA performance certainly this month. And it pretty much started when the Fed cut 50 basis points, and which was actually probably more than most people would have expected. But they probably didn't expect that we were going to get higher rates in the bond markets as a result of that. Now, of course, we know that other central banks have continued to cut since. ECB did it earlier this month as well. They're down to 3.25%, I think, now. And it was the first back-to-back cut in 13 years that they did. But what's really interesting and what sort of reminded me of this was a comment I saw from Paul Tudor Jones, the famous hedge fund manager who spoke on CNBC. And essentially, at least from the clip I saw, he's saying that whoever wins, and you and I promised not to talk politics, so we're going to stick to the Paul Tudor Jones part. He said whoever wins, he fears that there will be kind of a point of recognition where bond vigilantes, and for all I know, he could be one of them, may start to vote with their feet and give a vote of no confidence, not so much to the candidate, but actually to the budget plans that either of them really stands for. He shared a chart that shows the U.S. budget deficit, could go to as much as 200% of GDP in 30 years if we continue down the path. Right now, the U.S. debt, according to this interview, is $35 trillion. But the income from tax receipts is only $5 trillion per year. And the deficit at the moment is running at $2 trillion a year, and it continues like that as far as the eye can see, again, according to him. And then he made a reference to something that you may know about. I did not know about this because it's not a sport that I follow, but he compared it to this wrestling entertainment. It's not real wrestling, of course. It's very popular. Naturally, it is, and so there's something apparently there's a term called Kayfabe. I'm not entirely sure what specifically it means, but he called it an economic Kayfabe, where the fact that you're looking at something, it's an illusion what you're watching, but you're asked to believe that it's real. And so he expects kind of a Minsky moment coming at some point, and he was asked what about fixed income for his own portfolio, and he said quite emphatically he's not going to own any fixed income, and he'll be shorting the back end. And I think this is super important, and we know not that many strategies are able to profit from a long-term bear market in bonds, but trend following has actually proven that it can very recently. So anyways, that caught my attention. Any thoughts?
Yeah, lots of thoughts. WWE, of course, is potentially one of the reasons why one of the candidates is sort of in the public eye, because he I think the first time he was on television was when he appeared at one of those WWE shows. But anyway, we aren't going to talk about him or his opponent. I'm reminded of the, one of these so-called widowmaker trades. The widowmaker trades in financial parlance are where essentially it's a trade that you put it on, the market keeps hitting you with a stick. And it just never, it looks like a trade that should always be profitable and never is. And, one of the great widowmaker trades the last 30 years was shorting Japanese government bonds. And the reason it was a widowmaker trade was everyone was like, well, this is crazy. The Japanese economy has got very slow growth. It's got terrible demographics. And as a result, there's a budget deficit. There's a huge amount of debt. Surely interest rates are going to have to go up. Therefore, we should be shorting Japanese government bonds. And one of the nice things, of course, about being trend followers is we could ignore all of that, and we could just say, well, these Japanese government bonds are still going up. Let's just buy them. And in fact, I remember very clearly that when I was running the fixed income book at AHL, one of the greatest trends of all of the time I was running the book was the long in Japanese government bonds. And from memory, it basically went up. It was pretty much a straight line. And then in February 2013, it sharply gapped down and we closed our position. And we were probably long Japanese government bonds like 3 years. While lots of people saying, oh, this is insane. Interest rates were basically zero and staying at zero. It was pure carry at that point. We were, but it just kind of kept printing money. So firstly, I'm glad I'm not in a position where I'm expected to make discretionary calls on the US bond market. Definitely, for sure. I don't want to do that. That's a business I think is very difficult. I think Japan shows us that there are good reasons why a country that, like the US, that can print its own currency and also has a currency that is, is the currency of the world, and people will be buying US assets and investing in US assets for, continuing into the future. I don't feel it unlikely that personally that we'll see a situation where US interest rates end up having this Minsky moment. I think it'll be more like Japan. I think they will, there's no reason why the US as a country can't support quite a large federal debt, even larger than it's got now. The other point I would make is if you do look at demographics, one of the things that happens as you get an aging society is people do move more of their investments into fixed income. And therefore there is more demand for bonds. And that'll be another thing that potentially would be keeping interest rates low. I could be wrong, but I can see very strong counter arguments against Mr. Tudor Jones, although obviously he's a man who's been much better at making discretionary calls on the market than I have. And I didn't even know he's still alive, actually. So
I know he's not that old, actually, and he looks pretty
He just
well.
seems like he's been around a very long time.
Well,
I think he started quite young.
Well,
yeah.
he has, but as you also know, then probably is that he's kind of started his career as a trend follower. So it's kind of an interesting, way. And actually, I think 3 or 4 years ago, he came out also on television and said if he had to put his money in one strategy, and this is after 4 or 5 years where trend following had not done so well, he wanted to put that in trend following. And then, not long after, we had a fantastic run. My last comment to this is because I don't disagree with what you said. I don't disagree with what Paul Tudor Jones said either. But it is interesting because the conversations that I have with investors is very different to the sentiment that he's expressing, where he's expressing major concern about fixed income. I see the opposite. People are so excited and they want to essentially just buy fixed income because now they can get 4 or 5%. They haven't been able to do that for a while, thinking that's a great deal. And of course, if Mr. Jones is right, it may not be such a great deal. We'll find out. We'll talk about it again in a few years, I'm sure, Rob. So,
yeah. And in the interest of transparency, just very quickly looking at my own book, I am short bunds. But that does seem to be the only sort of fixed income position I have. So,
well, there we are.
It looks
you're
like
Paul Tudor Jones. You're shorting the long end.
My computer agrees with Paul Tudor Jones, at least with German bonds anyway, not US, but where I have no position. Anyway.
Fair enough. Good stuff. All right. Let's move on to the quick trend following update, but we are going to stick with fixed income as a theme because that's probably where trend followers are hurting the most this month, despite long exposure becoming smaller in bonds, but they are hurting from the corrections. And equities, of course, as well, correcting this month so all of a sudden. And some currencies are also becoming a little bit more difficult. I guess the only thing that's shining this month really probably is gold and silver, at least in terms of the liquid markets. I don't follow all markets, of course. and most other sectors are really kind of mixed to flat. My own trend barometer finished at 32 last night. I should say we're recording on Thursday this week, so that would be Wednesday evening. That's on the weak side, suggesting trend followers will be losing money this month. Yesterday, Wednesday, was a down day, so keep that in mind when I mention the numbers so far, because they will be as of Tuesday this week. BTOP 50 down 1.25%, but still up 2.88 for the year. SocGen CTA index down 1.83%, up 63 basis points for the year. SocGen trend down almost 3% this month, now down 71 basis points for the year. The short-term traders index is down 62 basis points, flat as a pancake this year. MSCI World down 68 basis points, but still up 16.67% for the year. The S&P Global Development Sovereign Bond Index, such a long name, down 1.31% this month, but still up 1% for the year. And the S&P 500 up 61 basis points, still, as of last night, up 21.5% so far this year. Any thoughts other than that, or should we jump straight? We have so many questions.
Yeah, let's move on. We've got some great load of questions this week. Okay. Thank you to all our listeners for those.
Yeah. Absolutely. And in no particular order, in fact, I probably should have listed the ones that came in first as the first questions, but bear with me. We'll try and get to all of them. The first one is from CryptoCaptainX3. I think I can safely mention the whole name because it's not a very descriptive. He writes to Rob, in this case, how do you manage intraday adverse price movement risk while running a daily system? Presumably, if you generate signals based on volatility and return forecast n times a day, then we have to run dynamic optimization n times a day, and then we can use the buffering approach you mentioned. So, a bit of an insider there. Thoughts?
Yeah, well, the getting away from the specifics of how my system works, which I might return to in a second. If you're doing a slow trend following strategy, most people will do their backtesting on daily data because we're trading sufficiently slowly that the advantages of moving to hourly or even tick data are very, very marginal. And a really good test to do when you're doing your backtest on daily data is to see what effect it has if you delay your fills by one business day or even by 2 business days, and just see what effect that has on your performance. If the effect on your performance is significant, and by significant I mean more than, say, 1 basis point to Sharpe ratio, so that's actually not very much, but it's basically enough that you'd see a difference visually on a kind of a count curve, then you should probably think about either getting hourly data, because it does look like your system will be sensitive to delays and, potentially delaying your execution to the following day or the day after. Or it might be that you're actually trading too quickly and you actually maybe need to sort of slow your system down and look at your trading costs to see if that's the case. So if you do that exercise, and I've done it, and you see that there's no difference at all between executing at today's close or tomorrow's close, that's telling you is basically that you don't care about intraday price movements. Essentially, you generate a signal. Well, the way my system works, where a lot of people's systems work, you generate a signal on a closing price, and then you basically sort of the next day try and execute the trade that comes out of that. And if the price has moved a lot between where you sort of execute the signal and where you actually end up trading the signal, in theory, at least, you should be agnostic towards that, because in a back test where potentially prices have moved a lot from one day to the next, that on average, that makes no difference to your performance. Yes, it will introduce a bit of day-to-day noise. Clearly, if a market has moved a lot, it'll change the fill price that you expected to get. And were you to take that new price and feed it back into your system, it may give you a different trade that you want to do. But again, if you're trading slowly enough, then moving the last price and a whole series of prices by even quite a large amount won't change the desired position that much, to be honest. So that's kind of the sort of, the way I would describe it. Now, my own system is a little bit more sophisticated in that, and what it actually does is look at the positions it currently has, looks at the positions it wants to have, and then does a dynamic optimization. And what that means is that in theory, I could actually run that system on an intraday basis and run it every hour or so. And that would be a way of sort of picking up the new prices that are coming into the market. Of course, while still potentially having stale prices in markets that are currently closed, and just sort of dealing with that in a more sophisticated way. In practice, to be honest, I don't bother doing that. So I essentially do this thing of just trading on what yesterday's close was, and then not caring if the price has moved a lot.
Do you have any threshold in terms of if you only need to change like one lot or whatever, you don't do it until it's more than one lot?
Yeah, so my system I used to trade had a what's called a buffer in it, where basically, in very rough terms, if the price had changed by 10% of kind of my sort of standard position unit, which is vol adjusted, then if it's less than 10%, I wouldn't bother trading. To be honest, because of the size of my account, that doesn't make that much difference, to be honest. My new system is a bit more sophisticated. What it does is looks at the overall portfolio and basically says, well, this is the portfolio I've got on now. This is the portfolio I'd ideally want to have if I don't have trading costs. Is it worth moving from here to here, given that trading costs exist? And basically, that means that it might be that on some days I don't trade at all because it's just not worth it. Or if I do trade, it'll be in markets that are cheaper to trade. So that's a sort of more sophisticated way of doing it.
Yeah, no, that makes sense. Then CryptoCaptainX3 also goes on to say, also how to manage overnight gap risk for futures instruments which trade only 6 hours a day.
Yeah, I kind of answered that.
Yeah.
I'm basically saying you don't care about, in your back test, you essentially say there's no difference between me executing at yesterday's close and today's close. So I don't care about, the sort of surprises happening overnight either. I just know that on average I'm going to be okay.
And then final question, let's say I want to trade directional strategies, but instead of using futures, I want to use options depending on forecast strength, a mixture of short options and long options. For example, if extremely strong cap trend forecast 50% long options, 50% short options. If extremely strong carry forecast 100% short option. What are the pros and cons of this?
Well, the main con is that options are more complicated than futures. So from a kind of implementation and infrastructure and data perspective, there's a lot of work to do. Generally speaking, if you're buying options actually is quite similar to trend following in the sense it has a very similar payoff structure, especially for short-term trend following. If the market goes in one direction or the other, then you have a sort of non-linear payoff of whether you'll make money or not. If the market stays where it is, you'll get whipsawed and you'll lose money. So that's kind of like paying an option premium. So we can actually treat trend following, particularly short-term trend following, as a bit like buying an option without buying an option, or we can buy options. And the difference between those two approaches is that with the explicit buying of an option and buying of a premium, you're paying what we call the volatility premium. You're basically paying for the fact that, generally speaking, options are more expensive than they should be given where volatility generally ends up. So buying options consistently is a money-losing strategy. And, the reasons for that are people like buying insurance policy. They like the certainty. If you think about it, if you're going long a market, if you do it by buying a call option, then your downside is limited. And that sort of certainty of position is kind of quite a nice thing to have. And also, if you buy a call option, it sort of does this natural thing of kind of buying more as the price goes up, which is what trend followers tend to do, either because of the way the signal's constructed or because they're using some kind of form of pyramiding. The buying a call option automatically does that for you because as the price goes up, the delta of the option goes up, which means you've effectively got more exposure to the market. So it's quite nice in that sense. So if I was to replace my futures trading portfolio with a system that just bought options if I thought the price was going to go up and sold options when the price was going to go down, I would expect my performance to be significantly worse. Because I'm now essentially, rather than buying these options implicitly, I'm buying them explicitly. I'm paying the premium. I'm paying the volatility risk premium to the market. Now, you can be a bit smarter than this. What you can do is say, well, what I'm going to do is I'm going to trade options and futures, and I'm going to put on a bet in the most efficient way possible, given my forecast for direction and volatility and implied volatility. So that sounds quite complicated, but let's give a really simple example. Suppose I think the market's going to go up. So I know I want to have something that's going to make me long, okay? And let's keep it simple and suppose I have the option of either buying a call option or buying a future. Which of those choices should I select? Let's not use the O word twice in a different way. Which of those choices should I select? Well, if implied volatility is currently really low, and actually below my forecast for historic volatility, it may make sense to buy the call option because the call option is going to be cheap. And that's going to be an efficient way of getting that risk on. If conversely, implied volatility is high, and on average this will be the case, then I'll want to buy that future instead, rather than paying this big fat premium for the call option. Things get a bit harder to get your head around when you also introduce the option to short options. And when you do that, what you will find is that you will end up with a system which has an interesting behavior, because it's going to have elements of both trend following in it, but also it's probably going to be systematically short vol. It's going to be biased towards selling options because, as I said, generally speaking, there's a volatility risk premium. So you're going to have this interesting strategy where you've got the positive skew properties of trend following combined with the negative skew properties of option selling. But in theory, at least, that system will have a higher Sharpe ratio than something that just trend follows using futures, because it's got this additional source of return from option selling and also from being able to tactically buy options when they're cheap.
Yeah. All right, cool. Moving on to a question from Taylor. And actually, I think we have answered the question, so it's going to be very quick. But I want to recognize Taylor for writing in. He says, how do you think about position rebalancing and the trade-off between maintaining your desired risk allocation versus minimizing transaction costs?
Yeah, so as I said, very quickly recapping, there are sort of two ways I've done this in my career. The way I used to do it was a very simple way where essentially, if you actually look at the theoretical literature around rebalancing, essentially, if you imagine transaction costs were zero, then you'd always rebalance. Like, irrespective, like if your position was out of line with where you wanted to be, you'd always rebalance, because if transaction costs are zero, there's no downside to doing that. Introduce transaction costs and things change. The more transaction costs are higher, the more tolerance you're going to have from being away from the position that you want, because you're basically saying, well, yeah, I want to have this position here. I'm currently in a different place, but actually it's going to cost me, 50 basis points to move over. Well, it's not really worth doing that. So I'm going to wait until the position's even more out of line, and then at that point I'll rebalance. And there's this idea of rebalance, depending on the kinds of costs that you have, and whether you're a retailer or an institutional trader, there's sort of different theoretical ways of doing it, which I won't go into detail now, but I have talked about in my books and on my blog posts, so people can refer back to that. That's the way I used to do it. The way I do it now, as I said, is already alluded to again, is more sophisticated. And what that does is look at the whole portfolio, and it's basically doing the same thing, which is it worth going from the portfolio I've currently got to portfolio I'd theoretically have in the absence of transaction costs. And that's going to result in sort of more nuanced decisions, like, for example, yes, okay, let's say that I'm currently short bonds, and my theoretical portfolio wants to be long bonds. What I'm probably going to do is go long and buy more of bonds that are cheaper to trade, and possibly not even touch if I've got other positions that are really expensive, I may not even touch those. So I may end up with a sort of getting my bond exposure through the market that's currently cheapest for me to trade. So it can do more sophisticated things like that, which is, less intuitive, but again, theoretically is a better way of doing it.
A quick question, by the way. Do you have like a ballpark figure of how much total transaction cost commissions you pay every year? Just a ballpark.
Yeah. So my standard annual standard deviation target's about 25%, and I pay about 1% in transaction costs.
Okay.
So it's sort of 1/25th of my risk target, if you like.
Right. Yeah. So I think it might surprise people that it's not a massive amount transaction cost, and I actually think you're a little bit on the higher end compared to, for example, what we are when we.
Well, bear in mind as well, I'm a retail trader, and half of those costs are commissions and half are spreads. If I was an institutional trader, I'd probably be able to get those commissions down quite dramatically, and I'd probably be looking at more like 60 basis points. of which 50 basis points would be spread, 10 basis points would be commissions. So that's one reason why I'm a bit higher than most institutions.
No, makes sense completely. Still good. All right. Quick question from Richard. There's a few questions actually. I see. Last year, I launched a small systematic fund which trade equities and futures using a lot of your ideas and framework. Things are going well so far. I'm grateful to have come across your books and blog. If you ever find yourself in Australia, please get in touch. I think I should have probably left out that one, but there we are. In your book, Systematic Trading, you describe position inertia, a method of avoiding frequent small trades by widening the target to 10% above and below the desired position. Have you considered varying the parameter depending on the estimated trading cost of the instrument? Now, I mean, again, I didn't read ahead. I should have done, because these are all the same questions.
Yeah, well, no, actually, this is quite interesting, because having described the method of position inertia, I can now explain where this 10% figure comes from. And yes, so the truth is basically that in theory, you should actually, have a wider buffer if an instrument's more expensive and a smaller buffer if it's cheaper. And that just intuitively makes sense. In practice, however, I'm a simple guy, and to me, it was just too much like hard work to have a different size buffer. Also, because I'm trading retail size trades and most of my trades are a single lot, using, say, a 5% buffer or a 20% buffer probably isn't going to make a lot of difference to me. So 10% is basically a conservative value that for the vast majority of instruments that I consider cheap enough to trade would be the right value. But yes, in theory, and certainly if I was trading institutionally, I would use a buffer that varies, definitely.
Here's a question actually from Richard that actually I find interesting to hear the reply to. And he's saying, I currently use a rolling 10-year window of weekly returns to forecast correlations between futures instruments, as you suggest in your blog post in 2020. Do you think there would be any value in applying an exponential smoothing to the correlation forecast?
I really want to link that blog post, because so I may have miswritten in the blog post, but let me just quickly explain the two different ways I estimate correlations and why they're different. And it comes down to what the correlations are for. So the first thing I might want to estimate correlations for is if I'm looking at the underlying instrument returns themselves. So, what's the correlation of, say, two things we talked about already of the Bund with the US 10-year bond? It's going to be probably like 0.5. What's the correlation of, say, the Bund with, say, the Schatz, which is the German 2-year bond, was much higher. It's going to be about 0.9 probably. Now, that I use for things like estimating the risk of my current portfolio, which, as I said, I use in my dynamic position sizing algorithm. But also, it's the standard way of measuring risk is you look at the positions you've got on, you look at the correlation of the returns of those positions. That's sort of standard financial mathematics. Now, for that particular use case, I actually use roughly a 6-month window, and I do use an exponentially rolling method. So 2 separate points there. The reason I use 6 months, not 10 years, is that, correlations between market instruments do change. Between the Schatz and the Bund, not so much. But between US 10-year and Bund, which is German 10-year, there's going to be times when the US and German economies are doing quite different things and their rate cycles are going to misalign and the correlations will be lower. There'll be other times when they're moving in lockstep, probably during crisis periods, because both Bunds and US 10-years are seen as safe haven assets. So you'd expect the correlations to go up in crisis periods. That's kind of a truth about financial markets, is that correlations always move to dramatic levels when there's a crisis, partly because of things like flight to safety and partly because of sort of deleveraging events that are happening across a lot of assets at the same time. But anyway, I'm digressing. So I use 6 months because that is a good balance between being too fast and therefore the correlation is moving around too much, and being too slow and not picking up essentially regime shifts. And why should you use exponential weighting rather than non-exponential weighting? Well, exponential weighting has sort of this nice property of updating with more recent information and weighting that more heavily than information that's longer ago, which intuitively makes sense, but also is smoother. So if you use a fixed window, imagine that using a 6-month fixed window, and 5 months and 28 days ago, there was a huge return spike, a huge difference in returns between two assets. In 2 days' time, when that kind of rolls out of your 6-month window, your correlation estimate will sort of change quite sharply, potentially. Obviously, this is more of a problem for short windows. 6 months isn't too bad, but for short windows, it's a very serious problem indeed. Using an exponential weighting, that kind of big spike will gradually dissipate out of your returns rather than jumping in one go. So if I'm measuring the correlation between instrument returns, I definitely don't use 10 years. I use about 6 months. Now, let's suppose that instead of measuring the correlation between the underlying instruments, I want to measure the correlation between the actual trading strategies themselves. So instead of the Bund and the US 10-year, I now have a trend following strategy on the Bund and a trend following strategy on the US 10-year. The correlation between those is going to be lower than the correlation between the actual assets themselves, for reasons that I'll actually explain later on in the episode. But more importantly, it's going to be more stable. Generally speaking, there won't be kind of episodes when that correlation is very high or very low. Of course, it will vary a lot, but it's actually more stable over time. And because it's more stable, I actually want to use as much data as possible, 10 years, whatever, 10 years, 20 years, 30 years, as long as it's kind of more than one economic cycle, that's probably long enough, assuming you've got enough data to do that. And with a big long window like that, using exponential weighting, it doesn't really make a lot of difference. In fact, in my own code, I do, but because it's such a huge long window, it's not going to make a lot of difference. So I would be curious to know if I'd actually suggested that in a blog post, because as I said, the 10-year window I do use, but only for correlations between sort of what I call sub-strategies. For correlation between instrument returns themselves, I do use a much shorter window. And yes, exponential smoothing is definitely the way to go.
Yeah, I mean, glad we made that clear, and maybe Richard need to just go and check what he is doing in relationship to that. Let's move on to a quick question from Michael. I think this is also a very quick one. He just writes, how do you monitor that your systems are running normally intraday without checking the performance?
So I have basically my system publishes a web page every 10 minutes. And I can click on it now. Even, of course, the viewers at home can't see this, and neither can Niels. But I'm clicking on it now, and it's showing me that all the processes I expect to be running are running. And if any of them crashed, it says crashed. And if things have gone really pear-shaped, it also shows in it when it was last updated. And if that's more than sort of 10 minutes old, I know that the whole machine has gone down, or perhaps just this monitoring process has gone down. So that's sort of how I keep track of things in day. And the other thing is that my system sends me emails basically every night saying everything seems to be okay. For example,
sleep well, Rob.
Sleep well, Rob. Yeah. So I can tell you, for example, that I've got what I call a status report that basically checks that all those processes are. So if I haven't clicked on the intraday thing for the whole day for some reason, it basically says, "Oh, look, this process is delayed. It should have started. It hasn't started, or it's crashed." It also says things like, you haven't had a price for this Chinese index equity future for 2 days. That seems unusual. There may be a good reason. It might be a holiday in China. Maybe the exchange is closed. But it may be also that there's a problem with my data feed. And it's say things like, oh, look, normally you generate a position every day for this market. You haven't generated one. It, again, is that an issue with the substituent system running? And it also does things like say, oh, look, here are the positions that the broker thinks you have. Here are the positions I think you have. Hang on a second, there's a difference between them. Most likely what's happened is the future's expired. So I've built a whole infrastructure of things around the fact that essentially I'm quite a lazy person, and I've got better things to do than sit around watching a computer run. So I made the computer kind of constantly say to me, yeah, it's fine, it's fine, it's fine, it's fine. And then suddenly go, oh, it's not fine. Just to make the actual work involved with running the systems be the absolute minimum.
Good stuff. Now, you may fall into the AI category in the article you talked about earlier.
Another one of my bugbears.
I'm not going to go down that road now. Now, we have 2 more questions, Rob, but I need very short answers because otherwise we won't get to the real meat of the conversation today. Another Richard writes in, I've read Rob's book on systematic trading and thought it was in the top 5 books on the subject of all time. He talked a little in there about allocating capital between trading strategies, but the method seemed quite manual. I'm wondering what method he would use to dynamically allocate capital between different strategies in a live system, given dozens of strategies, all with changing performance over time. 1 minute answer.
Well, the short answer is no, I don't do that. And I don't do that for two main reasons. One reason is I've got, a lot of decades and decades of backtests, different strategies. And I'm likely to see a statistically significant change in what I think their performance is like based on 1, 2, or even I've been trading for 10 years of data. The second reason is that actually it's very hard to see any statistically significant difference in returns. That means that generally speaking, when I'm doing any kind of optimization, I usually almost completely ignore the performance of strategies and instruments. And that's why I can use quite simple I think when he says manual, that's code for simplistic. I use quite simplistic techniques that actually work much better than any kind of more sophisticated techniques that are likely to overfit. I can use those techniques, definitely, but when I use them properly, taking into account sort of statistical significance, I generally find they give me results that are very similar to what doing this very, manual, more simplistic ways.
Sure. Cool. Good stuff. Last question. It's from, I think his first name is Cloud. Could be a her. I don't know. There are some questions I really would like to get answered. One, among the strategies such as momentum, horizon, acceleration, how do you select which strategies? It seems more like strategies are making money on some instrument, but some of them do not. Also, as time goes by, it looks like some of them became non-profitable. Are there any ways of optimizing to pick the right strategies and instruments in a profitable way?
I just said don't do that.
Yeah.
And I mean don't do it. It's very, it's very, what looks like kind of a clear pattern. When you actually get down and look at the data and do proper statistical tests, you see actually the results are purely what you'd get from random chance. So I've got a very striking graph in definitely in my third book. I can't remember if I repeated it in my fourth book. But what I do is I get 100 instruments or so, and I rank them according to their back-tested performance for a particular set of trend-following strategies. And you see a very clear picture where there's an instrument on the left that does really badly, an instrument on the right that does really well. And just looking at that picture, you think, well, goodness me, what I need to do is allocate all my capital to this stuff on the right and ignore the stuff on the left. And then I add error bars. So I add error bars showing what the amount of statistical noise is and the estimates of those performances. And once you do that, what you basically see is that all of the error bars overlap. And what that's telling you is that actually you don't know for sure that this thing on the left is really terrible and this thing on the right is really good. And for that reason, you potentially shouldn't be trying to optimize performance in that way. At least the kind of trading that we're doing. So, high frequency traders, lots of data, statistical significance, entirely different matter. But for the slow trading systems we run, I just stay away from it.
Yeah, no, absolutely. And again, just think of the cocoa example where for 15 years it made no money, and the last 18 months it's made all the money in the world for trend followers. So yeah. All right, let's move on to the main event, which are two articles. The first one from a former colleague, I understand, at AHL. You have Git now at Gresham Research, and it is called Less is More or Less. Some of you may already have guessed what we're going to talk about if you're a long-time listener, but I will let you, Rob, lead the way.
Yeah, so this is one of the things one of the very few things that Niels and I disagree on, I think, which is diversification. So, Niels is currently wearing, you listeners can't see this, but he's currently wearing a t-shirt saying 50 markets is enough for anybody. Whereas I have over 300 futures markets in my own portfolio. So this is quite an interesting take on it. So Yav is a very interesting guy, very original thinker. He's also much better at maths than I am. He comes up with these little kind of things that I would never think of, just mainly because his maths is better and he's an original thinker. But what he basically does in this article is talk about the idea that returns in portfolios are driven by factors. Okay, so think about stocks, the stock risk factor, which we often proxy with the S&P 500. There's this idea of beta, where you say, what's the exposure of a stock to this factor? And, the original kind of capital asset pricing theory says, well, basically all stock returns should be explained by beta. There shouldn't be anything else on top of that. The idea is that managers try and outperform by getting alpha on top of the beta. That's where the term alpha comes from. It comes from this Kalplastic pricing model equation. But he does something quite interesting, which is to say, well, if you as you make your portfolio bigger, mathematically you actually get less diversification because you end up with less idiosyncratic sort of stock risk, and you end up with more effectively exposure to the underlying stock factor, the S&P 500. And I found this very interesting because I'm a big proponent of using equal rather than market cap weights in long only portfolios, because it doesn't basically, by using a market cap weight, you're saying that you think that, say, Apple or Nvidia are going to make you are worth having sort of 50 times more in your portfolio than whatever the smallest S&P 500 stock is. When I last checked, I think it was Gap, the clothing company, but it's probably changed now. Whereas with equal weight, it's just saying, well, actually, I think that Nvidia and Gap are about to do as well as each other. Momentum changes that slightly because obviously once a stock starts doing well, its weight will increase in a market cap weighted portfolio, and you'll end up with more and more of it. If stock does badly, its weight will reduce or maybe even get kicked out. So momentum actually makes market cap weighting look better. But in the absence of any information about stock performance, you should have equal weights. But what Yav shows is that even if you've got equal weights, as you add more and more stocks to your portfolio, basically it becomes more and more essentially like the S&P 500, even if you've used equal weights rather than market cap weights. So that was kind of interesting to me. Now, the other thing he then does in the article is to take this back to CTAs. Now, again, we can think of CTA performance as being explained by some factors. Now, it's less obvious what those factors are, and they may change over time. But I like to think that that there are probably 4, maybe 5 factors out there that potentially explain CTA performance. And generally speaking, from time to time, you can clearly see what's going on. Like a couple of years ago, we had the big movement in commodities. And there are times when if we go back to say 2008, it was a very clear risk-off bet with stocks selling off, bonds going up, and that explained basically CTA performance very clearly. So the factors may be different from over time and change, but generally speaking, there aren't that many big things going on. As a result, if you do the same argument, essentially of sort of saying, well, like I say, well, we should have 300 futures markets. What he said is, well, actually, you end up with this sort of strange situation where you end up with the portfolio becoming more and more like a series of, loaded towards a series of risk factors. So you may think you've got 300 bets. Well, actually, you've got 5 bets, and because your portfolio is so big, the contribution of each of these individual futures and the contribution of them of the sort of idiosyncratic risk, so something like cocoa that's completely off the wall, clearly, if you've got 300 markets and cocoa's only got one of them, well, that's not going to make much difference to your driving your performance. What's going to be driving your performance is these big kind of macro trends that are moving lots of markets together. So I found it thought-provoking, definitely. And I know that, so for example, if I look at the increase in performance in a back test of a trend following portfolio as I add markets to it, it does increase by a factor of about 4 to 5, which is brilliant. I mean, there aren't many things you can do that will bring you a 5-fold improvement in performance. But what that's also telling you is that actually there are probably only about, for technical reasons, it's the square, 4 or 5 squared factors, individual kind of independent bets that are actually driving your performance. And of those, between 16 and 25, probably only half a dozen are actually important at any given time. So, his now I have to say that of course, Yav is a smart guy, but like a lot of, he's working in the industry, so he's publishing this because he has a CTA that's different from what other people do. And I won't go into details about what exactly it's doing, but he's saying basically, well, you should be looking for things that have got lower correlation. So that if you're just a plain vanilla trend following CTA, there's probably no point in having 300 markets, unless you can do something very different with those, or go down the route of even like the alt market push, so the movement by people like Florian Core into alternative assets, even that's kind of only buys you a little bit more diversification. You might be introducing like one new risk factor, one new factor into your model, but really it's quite limited.
The way I think about it in a very simple way, and I don't have the math skills of any of you two, is that people often talk about, we can introduce more. And by the way, it's not that I don't think more markets will, improve. It's just that I'm not in a 300 market camp saying that it's better. It's different. I just don't think it's better. Anyways, but the way I think about it is that often when you hear this narrative, you hear it as, well, if I trade 300 markets, there are clearly more chances for me to find that one or two or three market that really has a big trend, as you rightly pointed out. As you also rightly pointed out, the position size is most likely going to be quite small, so it doesn't make a huge difference, really. But what is not, and it may even be worse, actually, because the position size is so small, but what is often not talked about is the fact, if you add another 200 markets to your portfolio, you're also adding the chance of 200 markets being stuck in a range and you losing money of those. So this is kind of just my simple reasoning for why it's hard to argue that it's better. And then, as I often say, and people will probably have heard this many times, when I look at all the performance databases I can find and have a really fairly good guess in terms of who is trading 300, 400 markets and who are trading, say, 100 or less, there is no evidence, in my opinion, that one is better than the other. And that's all I would say about it. But it's different, and different can be sometimes, useful. But I don't think it's better.
Yeah. It's worth saying as well that I've linked to an episode that Katie did earlier this year in March as well, where she talks about how this relates to skew. Because if you think that there's sort of these latent macro factors which should drive, trend following factors that are out there, then actually for the best skew, you want as pure an exposure to those factors as possible. So it's one of these classic things in finance, that you kind of, there's no perfect answer, between what you're getting. Adding more markets will, may well improve your skew, which actually is counterintuitive in a way, because you would assume that your skew will come from having these little independent bets that have going to go massively, to the moon, as they say in the crypto land, and provide that big right tail. But actually, as the portfolio becomes bigger, it's the exposure to the underlying macro factor with its positive skew that's doing that. The sort of little independent idiosyncratic bets, or if anything, actually, because the tails could be left and right, sort of wash out in the end. So yeah, it's interesting, and I think what's potentially interesting for someone who's in a sort of wearing a diverse, an allocator's hat, is that he's sort of arguing, well, maybe people allocating to CTA should be thinking a little bit more like people in stocks do, which is you have your kind of core beta allocation, which would probably be a fairly vanilla, low cost, CTA, and then you'd have something a bit more interesting to where you think there's potentially alpha and lower correlation. Now, the moment, I guess, it's an interesting argument. I guess most people and most funds are in the business of doing both, right? They're kind of selling you both at the same time, in the same way that if you go back a long time, if you bought into an equity hedge fund, a lot of the returns were coming from beta, and they wouldn't sell you the alpha separately, even though that's what you really wanted, and they would charge you fees on the whole thing. And I do remember a trend. I do remember a fashion about 15 years ago, and AHL participated in it as well, to launch a kind of simple, low cost fund with lower fees as a beta product. And I remember saying at the time, well, this seems, maybe this is good from an investor perspective. From a business perspective, it's kind of crazy because there's a big risk this could outperform the flagship fund, and people will be going, "Whoa, are we paying you guys, 2 and 20 when there's this thing here for 50 basis points flat?" So yeah, it's an interesting argument. The only caveat I would say, and I would agree with this, I think, is that this is all linear, right? Correlation is a linear measure of returns, and if we know anything, it's the financial returns are not linear, the correlations potentially probably understates the amount of diversification that's available as you add more assets, especially in trend following. And definitely that's what my own research shows me. If I look purely at correlation, the sort of diversification benefit should level off much earlier than they actually seem to do, because there does seem to be these kind of non-linear extra returns coming in as you add more of these assets.
Maybe we saved the best for last. I don't know. Maybe in terms of your pet peeve, we certainly have saved the best for last, I think. Now, we are going to talk about replication, because a new paper came out from the guys over at Newfound Research, Corey Hofstein's team, and they always are worth listening to and reading what they write. The paper is called "In Pursuit of Trend Following Beta: The Promise and Pitfalls of Replication." I think people know that some of my views, maybe not all of them. Of course, I speak about this with Andrew quite often. But I don't know if we've all talked about it before. But I'd love to hear your thoughts and guide us through the key takeaway points. We probably have about 10 minutes to talk about it.
So the reason I wanted to talk about this paper second is actually one reason why replication should work is if there really are just a small number of kind of macro trend factors out there, and all the markets we're seeing are just kind of, effectively just living off those, if you like, then replication should make a lot of sense, because what you basically want to do is use the data to find those 4 or 5 factors, and then in theory you could build a portfolio that kind of replicates them and obviously without paying CTA fees, which is,
which are not 2 and 20, by the way.
Which are not 2 and 20.
Let me just stress that.
This was, like I said, this was 15 years ago, unfortunately, in the good old days. Actually, I mean, AHL used to charge even more than that, but for some customers, we won't go into that now. That's a reason why replication should work. And actually, the way I trade myself, I've described it briefly, is effectively a form of replication, in that there is a portfolio I cannot trade because I have a small capital account, relatively small account, that consists of positions in 300 instruments. And then actually on a day-to-day basis, I'm probably trading about 20. And that those 20 are effectively a replicating portfolio of the big portfolio. But that's replication based on a position level replication. So there are kind of very quickly 3 ways of doing replication. Okay, position level replication, which is where you start, you know what the positions need to be, and then you form a series of positions that get as close to that portfolio as you possibly can. The second way of doing it is through what I'd call a sort of bottom-up approach, where essentially you say, well, I know what trend followers do. They do things like moving averages. They do things like position sizing. Why don't I just build a really simple model that does that in, say, 30 liquid futures markets, and that's going to be much cheaper and more straightforward than the whole kind of business of trading hundreds of markets and doing much more complicated things. And the third way of doing it is basically through what I could call a return replication. And what you do here is you start off with a series of returns that you want to replicate, which is normally but not exclusively an index. So, the BTOP 50 or the SG index. And you basically, what you do is you say, well, I've got these futures, and what I want to do is essentially to produce a series of long and short positions that in the recent past would have produced the performance that I see in the BTOP 50 or the CTA index. So the 3 main approaches. My biggest bugbear is with the third kind of approach. And I'll probably touch on reasons why. The first kind of approach, I use it myself. Clearly, I have no problems with it. The second kind of approach, I also think is very valid and a very good way of, getting a kind of low cost CTA into the hands of people who, particularly, I think it's really good for something like an ETF structure where we don't have, you're trying to reach people who haven't got the capital to put into a managed account, for example, or to reach a hedge fund minimum. So it's really good for that. The third one, which is where a lot of the marketing and the noise has been around, and where this article is around, the return-based replication is the one I have a problem with. But anyway, let's talk about the paper. The paper's really interesting because it does something that I think is really good, which is rather than using real data, it uses random data, randomly generated data. And this is a brilliant approach that I think quants should use more, because it reduces the chances of overfitting. Because what it's essentially doing is saying, well, look, if we look at replication based on real data, it's worked really well, but that might just be a fluke. Okay, we don't know for whether that it just so happens that because of the way trends have worked out in the last 30 years, that you could do replication very easily. So instead, we're going to use random data. We're going to basically randomly generate a bunch of pseudo CTAs and a pseudo CTA index, and we can repeat that experiment over and over again, and we can see how well replication does. So that approach itself is really good, and it's an approach that's really useful. And actually, there's a lot of useful thought and color that comes out of that. So, for example, the dispersion we see between different CTAs that have quite high correlations, if you look at the returns over long periods on a year-to-year basis, it sort of reproduces that effect. So, it reproduces the fact that in some years CTAs have a big dispersion in performance. In other years, they have small dispersion of performance. And if we go back to this idea of kind of latent risk factors driving performance, then what that's telling you is that in years with low dispersion, probably there were one or two big factors that, everyone made their money out of. In years with high dispersion, there was a lot of weird things going on in different markets, and depending on what, exactly how people trade those markets and what the market's weights were, they'd get quite different performance. So that's really interesting. The article then goes on to talk about the sort of replication process. And what they basically do is say, well, given this artificial universe, we've got these artificial CTAs, how well does replication do? And, it does very well. And they kind of find that sort of the first two factors drive a lot of the performance in this sort of pseudo universe. And therefore, and the first, say, 30 factors basically explain everything. And therefore, you only need about, say, 30 futures, as long as you choose your universe to have a reasonable amount of independence. So if your 30 futures are all US bond futures, then I'm not sure if there are 30 US bond futures, but if they were all the same thing pretty much, then of course replication would do very badly. You need to have a good spread across asset classes, and for various reasons you'd want to potentially choose more liquid instruments as well. And they have this interesting calculation that I've never seen before that's really interesting, which is basically to say, well, what's the amount of variability caused by replication versus the index? And what return can we expect purely through cost saving? And they say, well, the return's like a return and the variability is like a standard deviation. Hey, boys, what we've got here is a Sharpe ratio. So if you divide the potential saving through reducing costs by the kind of tracking error of the index, they say, well, we get a Sharpe ratio of close to 1, which
can I just comment on that particular part, because it was something I noticed as well. And what goes into their cost is 200 basis points of management fees. As I said earlier, I don't believe that's a good number anymore. 110 basis points for performance fees, that could be true, depending on what the long-term performance is. And then 275 basis points of unnetted transaction costs. And I'm kind of thinking, compared to the cost we pay, compared to the cost you just mentioned, this seems high. Let's put it that way.
It does seem high. And just to make it clear, the reason for this phrase unnetted is essentially, if you imagine a situation where you've got lots and lots of managers independently doing slightly different trades, well, they're all going to be paying transaction costs. If you had them under a single roof, you could actually get them to net off a lot of those trades, and as a result, reduce their transaction costs.
How would you be able to calculate that? Anyways, I'm just saying, I did notice that number, and I just want to say that to me, it's a little bit of a stretch.
Yeah, it is a bit high. And to be fair, I think what they're trying to do there is say, well, look, that's sort of basically a ceiling. Like, you're not going to get any better than this with replication, because actually the variability comes from an in-sample fit. Okay, so that's clearly, there's problems with that, which we'll talk about in a second. Secondly, that's like at the top end of the savings, and we can dig down on the numbers and so on and so forth, but it's probably not unreasonable to be able to make an extra 100, maybe 200 basis points through a combination of a little bit of transaction cost saving and a bit of fee saving. That's assuming that whoever's doing this isn't charging any fees themselves, of course. So you're going to have to take that off. But it's fair enough. So the other thing they do is then they actually do that's sort of as I said, that's like a ceiling. When they actually do this exercise on the BTOP 50, they find that they can't get to that near one sort of Sharpe ratio, if you like. They get down to 0.23. So that's 0.23. So we've gone from 600 basis points down to about a quarter of that, so about 150. So we're essentially, that proves your point, Niels. That the savings aren't really that large, but it's still 150, maybe 200 basis points, still better than a kick in the teeth. The other thing they do is they use so for this the problem with return-based replication is that you've got a series of returns. They're probably monthly, and you're doing a regression, and the regression window is, we talked earlier about correlations, about how long your date period should be to estimate a correlation. What you're trying to capture here is the effect of what happens when people's position changes sign. So you can't, go on, Niels.
No, I just want to say, you said the returns are probably monthly. I'm pretty sure they're daily in order to make the regression.
Yeah. So they're potentially daily. So you've got what you're trying to do. So you couldn't use even a 6-month regression, because the problem is during that 6 month, the position, it's definitely the size of the positions have changed, but the sign of the positions has probably changed as well. So you may do this regression, say over 6 months or a year or whatever, and say, well, it looks like we've got a positive load to US 10-year bonds, which is like saying that CTA manages the long 10-year bonds. Well, yeah, maybe there were 6 over the last 6 months of the last year, but they're not now, probably. So you've got to reduce the size of your window to capture that, which means the number of data points you use has to be lower. But the things you're regressing against on the right-hand side of your regression, you need to have quite a few of them to get some, let's say if you've got 30 instruments, 30 futures, liquid futures you're trading, because you need to have a reasonable spread, like I said. So for technical reasons, it's quite, if you've got a lot of instruments on your right-hand side and not many data points, regression becomes very difficult. And in fact, you get to the point where you theoretically cannot do it. So to deal with that, they use something called lasso, which is essentially a regularization technique for people who are into that kind of thing. And what that essentially does is say, well, you've got 30 futures, but actually to explain the returns over the last 3 months or however long you're regressing for, you really only need 5 of them to achieve your regression. So it's a nice paper. It has some interesting insights, uses a couple of novel techniques that I think should be used more. The main one being, as I said, this idea of random data. Lasso is used a fair amount. That's not something so special. But to me at least, and I've read this quite reasonably carefully, so I could be wrong, and if I am, I apologize. But it still looks to me like they're doing an in-sample test. So what I think a proper test of this methodology is basically something where you do say your regression, and then you form your portfolio of positions that you have, and then you say, well, how well does that do? Let's say you're doing this regression every week. So for that following week, you hold the positions as they are. How well does that do? And then tracking the portfolio, and we know that out of sample never does as well as in sample. That's why backtesting is such a fraught business. So to me, they're doing a lot of work to make something that fundamentally I think is a bad idea a little bit less bad. Okay, and we have an expression in this in English which is called polishing a turd. And that I feel like there's a lot of turd polishing going on here, because to me at least there are much simpler ways of if you want to get a simple, cheap way of replicating CTAs, you shouldn't be obsessed about trying to get a close match to, say, the BTOP 50 index. I think that people who are obsessed with benchmarking might think that's a good idea. But if you really just want to get some simple, cheap trend following, well, just do 30 futures in a very simple portfolio and just bung that into an ETF. To me, that's a much more sensible thing. And what that will do is automatically capture the change of sign, as we go, say, from being short bonds to long bonds or vice versa. It automatically captures that because you're going to have a little momentum model inside there that's doing that for you, rather than trying to kind of back it out from the returns of the BTOP 50.
Now, you may have read this more carefully than I have. I take some of your points. Of course, we're going to hear more about replication. As I mentioned earlier, these are smart guys, so we need to pay attention. There's one thing and this is from memory, where I think it focuses a little bit on this tracking error. And I think they come up with a number of 6 or 7 or 8%. Can't remember what it is as a tracking error. And then they say, well, it's not much worse than the tracking error, or it's more or less the same as a tracking error of managers, as far as I remember. But of course, managers are not trying to meet a benchmark. So I think the concept of tracking error as such is not so relevant. And one thing I have noticed with the replication products that are live, that we know of today, that Andrew represents, for example, as far as I remember, there is quite a lot of tracking error, frankly. The correlation is not super high to the actual benchmark, at least not on daily data, as far as I remember. So I'm probably more in your camp. Are you trying to replicate it with high correlation, or are you just trying to beat the benchmark with, a couple of percent because you think it's cheaper to run it the way you do? I think the narrative is a little bit mixed up, but maybe from a sales point of view, from a marketing point of view, it makes sense to say, yeah, I can save you a couple of percent by doing replication, but I'm not entirely sure that they truly replicate. And I guess that's my question. Do they truly replicate the performance? I think Harold from TransTrend wrote kind of a response to maybe some of the narrative where he said, no, they're definitely not, because they're not giving you all the diversification you get in the individual managers and so on and so forth. But I'm still questioning this in my own mind. What exactly is it they are delivering? Because if it's a true replicator, I would have expected the correlation to be higher to be able to claim that you're replicating something.
Well, as I said, I think for me, fundamentally, it's not possible to do a good replication job with a purely backward-looking measure based only on returns. I just don't. I think that's a fundamentally flawed way of doing it. And I can understand why, from a marketing perspective, you say, well, we're going to give you the benchmark performance less the fees paid by the underlying managers. Isn't that a wonderful thing? At the end of the day, as an individual person, what are you going to do? You've got a choice between lots of options, right? So you could, for example, if you've got enough money, pick, say, 10, 15 CTAs and dump, a chunk of money into them. You'd need to be quite wealthy to do that because, assuming you've got, say, a industry standard allocation of 5 or maybe 10% CTAs, and you then want to allocate, to 10 of them, well, you're looking at your 1% of your assets being a big enough ticket for them to accept. So that's an option available not to me, certainly, and to very few people even listen to this podcast, I suspect. Or you could say, well, I think I can pick a good manager and you invest in a single manager. Or you might say, well, I'm going to pick this manager. They're probably okay. They're doing something like trend following. The fees aren't too bad. But I know I'm probably going to have dispersion to an index, right? Because they're in a single manager, and by construction, even if they're included in that index, they're going to have dispersion to it. Something like just like the replication people can. Or you say, if you might say, well, what I really want to do is have a, of course, we could argue that it's misguided to go, like, so Yoav's argument is it's misguided really to do any of this, right? And so you might as well just pick a manager and try to pick one that's got, that's doing something different, because actually, if you invest in lots of managers or even in one manager with a diversified portfolio, you're just getting more and more exposure to a small number of latent risk factors. And if you genuinely believe that's the case, well, actually, something like a bottom-up replication done cheaply may make sense to you. It may make sense to buy something like an ETF that has, say, 30 futures markets in it and runs a very simple momentum model on them and only charges you, 50 basis points for the privilege. If you believe that there is just a small number of risk factors driving performance and that the benefits of diversification over lots of instruments, lots of managers are limited, then do that. But the trying to get the benefits of diversify across lots of managers via the BTOP 50 index, via a return-based replication process, I just think it's a bad move, really do. I wouldn't, so anyway, that's my piece.
I think, my final thoughts are, I think what some of this has created is, of course, especially in the ETF world, I think it's created an avenue for people who would not otherwise be able to get maybe an allocation, but this was before some of the managers now are offering their or some version of their strategies in ETF format, which obviously is another way to go. But in any way, it certainly attracted some assets from maybe smaller investors. I think that's a great thing. So I'm all for that. I think for institutional investors to say, yeah, let's just go replication route. I think, first of all, I question why would they even have a job if they're just selecting a replicator? Because they must believe that within managers, there is something called skill. And they must believe that they are themselves skilled enough to find managers that can over time persistently, create skill. I'm not talking about, every single year that they outperform, but over time. There are managers, we know that outperform the benchmark, so to speak. Rob, appreciate all the preparation you did to dig into all this information. I'm sure a lot of people would have enjoyed that. And if you did, please show your appreciation. Go to your podcast platform of choice, iTunes, Spotify, Amazon. Leave a rating and review for the podcast. And thank Rob for another great conversation. Next week, it'll be Alan sitting in for me, and he'll be speaking actually to Andrew. I have a feeling they're going to be a little bit of a rebuttal to what we've talked about, Rob, but there we are. We have no control over that.
Look forward to hearing it.
If you have a question for Andrew, or for Alan for that matter, you can always send them to info@toptradersunplugged.com, and I will pass them on to Alan. Anyways, that's it for now. From Rob and me, thanks ever so much for listening. We look forward to being back with you next week. And in the meantime, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.